What's up, guys? Zach from iTrendz here, coming to you with a W and M pattern, how to trade W and M patterns, little booklet presentation here, just to get you guys familiar with W and M patterns. If you guys are interested in learning from an iTrendz free learning session that we have virtually every week, you can go into the link in the description and hit the link discord.gg/iTrendz trading. That's where we host all of these free learning lessons, basically weekly. So if you're interested, feel free to hop in the Discord, hit up any member, any admin, and we'll get you situated. So let's get into it, talk about some W&M theories. So what is a Dow theory? What is a Wyckoff method? What are W&M patterns? That's what we're here to talk about, right? Advantages and disadvantages, how to identify, trade, and how not to trade them. We're going to talk about all those things today in a few short minutes. So what is the Dow theory or the Wyckoff method? The Dow theory, the Wyckoff method, those were both created in the 1930s. And they're based off of market accumulation and distribution periods, AKA those are the periods that are carried out by the people who truly move the market. They accumulate and then they distribute. So it's really important to have a good understanding of these methods here, the Dow theory, the Wyckoff method. Why is it important? Well, I just said it, because they're what govern the market. So it's pretty important to understand what they are. All wave theories are actually based off of accumulation and distribution periods. So your Elliott wave, or your 5-point wave period, or the XABCD wave period. Those are all based off of accumulation and distribution methods. So it's really, really helpful to understand what those accumulation distribution periods and methods actually look like. So that's why we're talking about the Dow and Wyckoff method. So W&M patterns. The W&M patterns are the patterns that are found inside of those market periods of accumulation and distribution. So think of those patterns as a direct reflection or a mirror of what governs the market movements, the accumulation and distribution. W&M patterns are reversal patterns. So they're not continuations, right? We either have a continuation period, a little stair step, bull flag, bear flag, etc., or you have a reversal pattern where the trend reverses from a bull trend to a bear trend. These are reversal patterns. That's what we're going to be studying today. The origin, it's actually really interesting. So these W&M patterns, they were first studied in 1971. By Robert Levi. He then abandoned the study for whatever reasons, and then it was picked up by Arthur A. Merrill in 1980, who created and coined W&M pattern. Now, before coining the W&M, they were actually described as harmonic or relating to the Fibonacci levels. If you're familiar with harmonic patterns, it's the same thing, harmonic W&M patterns, but those were founded by H.M. Gartley in the 30s as well. Kind of notice how they're all figuring this stuff out in the same time period, right? All these things kind of came together in the 1930s. So the harmonic pattern trading or W&M pattern trading, they're the same pattern. The harmonics just goes really deep into the actual mathematical equation that's backed behind the W&M patterns. So what are W&M patterns? We talked about them being reversals. So they are double tops and double bottoms, but there's one really big thing that is misconstrued with double tops and double bottoms. People think that a double top or a double bottom is a pattern that you play, but in reality, it's not a pattern that you play until it breaks the neckline, as we can see here on the left side, until it breaks the neckline to then break down, which in other words would just be an M pattern or a W pattern. So it's not a double top that you're playing, you're actually playing an M pattern or a W pattern, and you're just misconstruing the difference between the two. Now, a true double top or a true double bottom is not a signal to just go long off of or short off of. Once you break that neckline, that's when you get your confirmation, and that's when you can see a true reversal out of the pattern. Now, if the double top or double bottom is not broken down and reverses, but actually fails the double top, breaks through it, that's just a continuation. And now you have a bull flag that formed out of there, or say an inverse head and shoulders. It goes very deep. We're going to get into it real quick here. So I actually drew this on the presentation. I actually literally drew this for you guys. You can see I kind of messed up here. Nice and proprietary here at iTrendz. Everything that we do here is proprietary. We make our own everything. So subscribe for that because we're all proprietary here. So W&M patterns, they contain other patterns inside of it. You just heard me talk about bull flags 2 or 3 times there, which is definitely helpful to be able to identify, because then you can kind of formulate your entire segment, right? So let's just walk through this diagram right here really quickly. So this W pattern is a bullish reversal pattern. We've got the W. Once you break your neckline, right, little double bottom here, but you didn't take that because you don't have your confirmation. Your confirmation comes on the break of the neckline. We broke the neckline here. What do we have? We have a little bull flag forming here with a nice little pennant. Nice little pennant over here. And then once you break out of the bull flag, you have a little bit of a mini W in here. And your extension, if you know what your bull flag pattern technical laws are, the pole of the bull flag will be equal on either side. So if there's a 7% pull and then a consolidation period, you break to the upside to form a true bull flag breakout, your other pull is going to be 7%. So right here, we just say 3% flag, pull, consolidation, another 3% flag. Now you go down to retest that breakout, that consolidation period. You now are forming an M pattern. But inside of here, you don't have your confirmation to the downside until you break this neckline here or break out of the double top, which would just then be another bull flag, right? Another little bull flag up to the top here. But for this example, I drew it down, a little bit of a market accumulation distribution period. So your M period, your M pattern here is super important because once you break that neckline, you come down here, form a little W that begins to fail. And what do you have here after you break down below your double bottom and break down below? You have a bear flag. So your failed W turned into an M pattern to break the neckline to form an overall bear flag. So it's really, really important to understand what you're looking at when you're looking at these accumulation distribution periods, because you're looking at W and M's. Inside of your W and M's, you're going to have bull flags and bear flags and inverse and regular head and shoulders. And it's really, really important to be able to identify these because it's all going to play together. So moving on here, what are the advantages of knowing and trading W and M patterns? Well, one, everything becomes extremely clear. W and M pattern reversals are some of the highest probability setups, as there are a clear definitive point when there is a shift in control from the buyers to the sellers or from the sellers to the buyers. After you end up recognizing W and M patterns, all the other patterns become extremely easy to see. So that's also a great advantage of trading W and M patterns. And now we're on to some disadvantages. We got some kind of heartfelt disadvantages here. Everything becomes so clear that sometimes it's confusing on how clear it is. You're looking at the chart and you're like, is this really? This just seems too clear to me. But that's really the truth. You become infatuated with the waves of the market and the waves of the accumulation distribution periods. And then you stay up late, really, really late. Like one of our members, Jack, he's actually an analyst for us. He used to be a member turned analyst, amazing guy. But he's the type of guy to stay up late and study this type of stuff all night. He was literally up last night studying this all night. So, and then lastly, your last disadvantage is that you begin to see everything as a W&M, and then you unfortunately prosper because of it, unfortunately. So how to identify the pattern? Well, you got to pull the chart up and you got to draw your lines on it. You got to figure out where that M lies or where that W lies. But remember this phrase. This is really, really important. Zoom out, actualize, zoom in, actionize. The actual the technical business term is actually zoom out, actualize, zoom in, monetize. And yes, we're going to be monetizing it, but actionize I think fits here because you're taking action on what you're portraying, what you're seeing in the chart. You're taking action on that. You're going to make sure that you take action on executing on the break of the neckline down or the break of the neckline up. So we do need to start, right, zooming out. So we need to start zoomed out on our larger time frames and then gradually go inside, lower and lower and lower until we get that tunnel vision view on that 5 minute, right? So we can go from something like a weekly to the daily, hourly, 15-minute, 5-minute. You guys should know your time frames. If not, we actually have a starter kit that's free, which will be linked down below. That starter kit has a time frame ebook in it that you guys can check out. It'll tell you a little bit about each time frame, what you would use each time frame for. But anyway, back to what is at hand here. Zoom out, look at that daily, look at that weekly, then go down to the hourly, go down to the 4 hour if you'd like, the 15-minute, the 5-minute, etc. But the point here is that you're zooming out and then you're zooming in. So how to identify the patterns continue. There are actually 16. That CNBC might have been on in the background. I terribly apologize for that, but we're going to keep rolling here. There are 16 different W and M patterns in the overall W and M pattern. So I've circled the best, in my opinion, and in iTrendz as a whole here, the best W patterns to play, because you've got some wonky W patterns in here. I mean some M patterns, excuse me. You got some really wonky M patterns. Now, what's really interesting here is you have this messed up M pattern, but what would have been over here is another leg to form your W, your break of the neckline up is what you would have played here. But my point being, if you want to take a screenshot here, master these patterns that I've circled here. Very, very important, obvious setups. In fact, we literally just played, let's see if we can find it. It was a perfect M pattern setup. It was actually this M7. It was as clear as day on AMD here today on the 10th of February. perfect setup. Big drop on SPY. You already broke the neckline on SPY for the M on the day, and you looked right at AMD. It was setting up its breakdown. It was an easy, obvious play. So anyway, take a screenshot here and master these patterns. It will be very, very helpful. So how do we actually trade those patterns that we just looked at? Well, you trade on the break of the neckline. Now, technically speaking, down after the break of the neckline, you will go down to where the previous leg, the previous wave actually originated. So according to that Fibonacci law, that's exactly where that extension is going to go. So if, say, your leg started at arbitrarily 1, and then your tops were at 2, your midline was at 1.5, that break of the neckline down is going to go back down to 1. That's technically speaking where the Fibonacci, the law of Fibonacci retracements and the mathematics that go into Fibonacci retracements, that's technically where those put those. So that is law. Combine this with your identified levels of support and resistance, and now you have your potential rejection spots on the stock or your potential support spots on the stock. So what you don't do is you don't trade them by taking an entry off of a double top or a double bottom, because that could easily turn into a fake or continue the trend upwards. And if you get into that trade, you would have gotten stopped out, you would have lost some money, and those would have been a continuation. But these are reversal patterns. So remember that we need a break of the neckline for a continuation down, for a reversal off the trend to continue back down after we have reversed. So the best part about this is if you do know your patterns, if it broke to the top, like I was mentioning before, you have that bull flag, you have that bear flag, it's obvious to identify, and then you just play your reverse setup, a little smaller M or a little smaller W, break of the neckline, you play up, and then you have your Fibonacci laws there as well. So an example, this is a great example. This was back on the 24th of January. We actually played CAT for about a 400 to 500% gain. It was $1.25. We took the contracts to $5.10. It was an amazing trade, and I had been really wanting to smack CAT for a long time. So I was really, really happy that we actually did that, because boy, I just wanted to smack it so bad, because I missed this run up here, but I was keeping an eye on it. So as you can see, we clearly identified an M pattern, and we took the trade back up here. I went back on demand and took the screenshot and allowed you to see the full setup here to the full extension. But we took the trade on our first true neckline break, right? In iTrendz here, we always trade off the bodies, but we recognize that the wicks are just your extension for the outside ranges. But we always trade off the bodies because that's where the true buyers and sellers sentiment sits. So the true neckline break was at this 218.96, which we entered the play. We identified our lower range of support where we wanted to make sure that we break that on the day and we continue to the downside. So after we broke the 216.28, we took ourselves down to the M leg extension, all the way down to that previous support here, that previous resistance, now support. And we played all the way down, fully executed the trade off of the neckline, perfect neckline break down to the lower leg extension. So what is really interesting about this is that after, you can see, not only did we form a bear flag right here and break down, just like I was showing you in that hand-drawn scenario, but now we are forming a W. And so I'm actually looking to play the opposite now. If we have strength in the Dow and overall strength in the market, a little bit more strength in the market would help me feel a little bit more comfortable taking the call side on this. But if we have strength in the Dow, I will be looking for us to break our previous resistance over here, previous support that we played down to off the break of the neckline when we went short. I will be looking to play above the neckline to the previous extension up to our previous neckline that we had traded before after it broke. But here's one thing I do want to note. I'm a little conservative in my estimates here, so I will only be trading this up to this range right here. And the reason why is because I want to be just a little conservative in my thought process here. This 207.67 to the 215.38 could net another 400% return, and I will be perfectly okay with that. So I don't want to get too greedy here, although I do recognize that the true top of the leg extension would be at this 218.96. I just don't want to get too carried away. I just smacked it for 400 to 500%. I'll take the 400% this time and be pretty happy. So anyway, continuing, I want to overlay this with AMD, a graph of AMD on the daily here. You can see upside, there's a trading view chart. On the daily, I want to map this out. So inside a large M, you have smaller M's. And inside a large W, you have smaller W's that you can play. So as we can see, our leg extension starts down here at, let's say, this 120 value. And if we follow the blue line inside this box, of course, follow the blue line up to our first top. Now we have established our neckline here that came back down to 131.58. We then pushed back up to form another top. And then as you came down, once you broke this neckline, I remember, of course, I play AMD like every other day. We smacked, I just told you I smacked it today. We play it like every day. So this was a really, really easy play. Break of the neckline down to your previous leg extension was perfect. I could go back in the trades. I could see it was probably 100 to 150% play. Very, very easy. Break of the neckline, you're guaranteed to go back down to that lower extension. It's Fibonacci law. So what's really interesting about this though, and the main point that I want to get across here is that your large M has smaller M's inside of it. That way you don't have to wait for a whole month for this setup to set up, because that's literally what it was. November, let's just call it 1st to, oh my God. I mean, that would have been January, 2 months, 2.5 months. I don't want to wait for this whole setup. Inside of here, you have smaller M's that you can play where you identify your neckline. And what's great about this is your extension starts at your original neckline here. So there was resistance here where this M pattern started forming, and you would have seen this if we were only halfway through it about December, you would have only seen this much data, in which you would have recognized this M here. And you could have played this, if you had gone back, you could have played the neckline break down from, let's say, 150 flat down to your neckline at 131.58. And then you could have waited a little bit of time. And in here, there's a W pattern forming. This is a little bit less high probability. So if we were to be back during this time, I probably wouldn't have taken too much, because your previous neckline and your neckline that you had to break, there's a very small incremental move in there. It wouldn't have been the best risk to reward ratio that me personally, I would have felt comfortable taking. But that's just my personal preference, right? So every trader is different. So in here on the right side, on this right peak, if you want to call it crown, whatever you want to call it, on the right crown of this larger M pattern, you also have a smaller M pattern that you could have taken the break of the neckline down to your larger neckline at 131, netting you a good 100% on an easy options trade. It's just a break of the neckline down to the previous extension that you can identify. It's very simple, but it governs the market, and it's really, really, really important. So anyway, key takeaways from this. I know this was a little quick, but we're actually going to have a book that's going to be a bundle. Actually, it's going to have a bunch. We're going to have RSI. We're going to have W&M patterns. We're going to have the Fibonacci levels. We're going to have bull flags, bear flags, triangles, wedges. We're going to have a big bundle book that's going to be coming out about midway through March, maybe like March 20th. Quote us on it. March 20th, it'll be out. You'll be able to find the link for that in our future videos, or come into our Discord. Look on our social media. We'll be posting it all over there. But I highly suggest that you guys stick along for us. We'll be teaching them for free inside of our Discord. So literally just look in the description. We have the link there. Feel free to join us in there and join us every Wednesday when we're doing these free sessions. Or you can wait for the bundle to come out, hit us up then, and we'll have a bunch of it all together in nice ebook form. There'll be a couple videos to go along with it as well. Plenty of examples, and it'll be very, very, very in-depth. Will probably be 20 pages per book. That's about our average length of our ebooks nowadays, 20 pages per book. So if you took anything from this, W&M patterns, they're the mirror, right? They're the direct reflection of the accumulation and distribution methods, and those govern the markets. So when you learn W&M patterns, you learn the way to the markets. W&M, you learn the way to the markets. So double tops and double bottoms, another really, really, really important thing that I want you guys to get is that they're only true when they break the neckline. So in other words, you're just trading a W&M. So don't trade double tops and double bottoms. Recognize that this is a double top and that this is a double bottom, but trade the W&M pattern, or trade the bull flag or bear flag of a failed double top or a failed double bottom. So inside, the last key takeaway, inside that W&M pattern on a larger time frame, lie more smaller W&M patterns that are all tradable. But note, I said not all have the same risk to reward ratio. So make sure you're getting a good risk to reward ratio with necklines that are farther apart, where you can play in between them, and make sure your extensions extend out a significant amount. They're not a couple points away or a couple percentage points away. And that way your risk to reward gradually goes up and your profitability gradually goes up. Anyway, that was the W&M patterns, how to trade those. I know it was a little quick. So again, hit us up in our Discord. All links will be in the description, social for IG, Discord, our website. They're all in the description. Again, this was Zach from iTrendz. I hope you guys learned something today. If you did, comment down below. If you want to see something in the future, please comment down below. We're taking anything that you guys are going to give us, honestly, because we don't really post too much on YouTube, but we are going to be ramping up our videos here coming soon. So if you guys have any suggestions or you guys want us to cover a topic or talk about something, just drop it in the comments. We really appreciate the feedback. It really helps us. And of course, hit that subscribe button because we will be putting out bunches and bunches more of content here. But with that being said, I am out. I hope you guys learned something and I'll see you guys later.